All right, so I'm going to walk you through a $1.12 million mobile home park acquisition financial feasibility analysis. So earlier this week, I shared on LinkedIn that I would be happy to do a second opinion or a feasibility analysis for 5 different investors who are currently evaluating deals and would love a professional opinion on the underwriting side as to how things are shaking out and whether it's worth their time. So I had someone reach out and they were looking at a mobile home park. So I feel there's a lot of people who've talked about mobile home parks, but they don't actually know whether or not the returns and the profit opportunity is there. Just given that sometimes the client base or sometimes the actual operations of mobile home parks or trailer parks can be a lot more difficult than other assets. So are they going to trade at the same cap rates as a Class A property in a dense metro? No, they're not. So there are returns to be had. However, there's more execution risk. So 3 risks in any deal. There's going to be your investment risk or the actual deal risk. There's going to be your financing risk, and then there's going to be the execution risk. So when looking at this deal, and you can see I have pulled up here, very high level information was provided. So it's family owned and operated. So in terms of the accounting, there's a lot of missing pieces that we're going to have to do our best guess at. And this is also before doing any due diligence, any confirmation of, market pricing or vendor pricing, anything in the area. So taking a step back, why I find this potentially interesting, a larger fix and flip with a lot more capital at work, and there's a very large vacancy. So in terms of a fix and flip, if they go in, buy this asset, they're able to fix it, get it fully rented out at market rates, and then eventually exit or just hold it long-term for cash, it could be a very interesting deal. In terms of the financing risk, they just need to be able to make sure they're able to make their debt payments. And then in terms of the execution risk, are they the investment team and do they have the knowledge and the wherewithal to actually go into a mobile home park and do what they need to do in order to fix the mobile home park and then get it rented out at full market rate rents. So what I have pulled up here is our share to the rent roll. And so again, just for confidentiality, because this is a potentially live deal, none of the specific property details have been shared, or I'm not sharing anything here, but you can see the rent roll. So there are 33 pads total in the mobile home park. So the first thing I want to look at is what income and what is current income in terms of revenues or rent from the asset. So you can see here what's occupied. There's call it 23 occupied, 10 of the pads are vacant, 16 were marked as good shape by the owners, 8 were in fair, and then 2 were in bad. In terms of park owned, so how many homes or mobile homes are actually owned by the family that owns the park, there were 10 owned. And then in terms of current rents, you're able to see that there's a pretty big discrepancy between these rents. Question there is why? Why is there such a difference? Why are some doing $350 and then there's one down here for $850, $703, and $625, one for $500? So $350 has been the median, it looks like here, but I'm seeing $350, $450, $500, $650, $703, $850. Lot of discrepancies, and what that leads me to believe is maybe there's an opportunity to move all of these to 400 or 450. So is there more juice to squeeze, assuming that we're able to make these assets better for the tenants that are living in them, or attract more tenants? So now we have our vacancy costs, and how I kind of looked at vacancy was, let's assume that the opportunity cost of not having one of these pads filled is $350 monthly rent. So that's a low opportunity cost. What if market rent's actually 400 or 450? So then we looked at the vacancy cost per month and then annually. So this was just getting our bearings on the current rent roll and what the vacancy is. So you're able to see there's 30.3% physical vacancy. So physical vacancy is how many pads do not, like the number of pads over the total number of pads that do not currently have tenants. And then in terms of the economic vacancy, that's looking at what is the opportunity cost of that lost rent over the gross potential rent. So now, we look at the sensitized vacancy. So I want to look at, well, what would happen if the opportunity cost wasn't $350 a month? What if it was actually higher and we could charge more for the rent? Well, then we're going to apply an NOI or a gross, an NOI margin to look at what would that mean in terms of net operating income for these different pads at these rents if we were to have them fully filled or fully booked with tenants. So then we can actually put a cap rate on that and say, well, what amount of value is there to potentially capture if we do fill in that vacancy and get this to where it needs to be with market rate. So now we want to build out a pro forma income statement. And this is where the high level feasibility comes in. And if you've looked at a lot of deals and a lot of underwriting, you know that very often there are a lot of expenses that are not accounted for in the shared financials or the, pro forma P&L that's shared with you from the homeowner or from the broker or from the private owner, whoever it is that's selling the property. So I looked at current. So let's walk through current first. So we were shared gross potential rent. So that was calculated based on if these were all filled in at 350, what would that mean? And then we look at the vacancy cost. So 42,000 is what they're currently paying for, and that's here for not having those units filled. So then we can put in an assumption for uncollectible rent as well as loss to lease. So loss to lease is our rents under what market rate or going rate could be for full market rate rents. So that gets us to our effective gross income. And then we look at the different line items that could all potentially be included for the deal. Now, this is where at a high level financial feasibility level, we don't know if all of these are accurate or even need to be included. But given the general asset type and the types of expenses that this property is most likely going to have, we can plug in reasonable assumptions in order to build out the P&L to get down to our projected and our current net operating income. So when I look at a deal, I want to look at what are current rents, actuals. So trailing 12-month rents, I want to know how much is actually coming in. Then I do not want to take whoever the brokers or the owners, I do not want to take their expenses and say that that's as is. What I want to do is assume, let's pretend we buy this day one. What do we expect our expenses to be, our pro forma expenses as the property currently is? That's what we want to include for the current expenses. So we're taking the trailing 12-month revenues, and then we're taking what we reasonably believe will be the pro forma expenses, and then we're going to calculate out the current NOI based on those assumptions. Then what we want to do is look at the potential revenues, where if we were to fix it up, we were to charge market rate rent, and we were to fill the vacancy, how would that affect our gross potential rent, our effective gross income, and then all the way down to NOI? How would that lift NOI? Where a lot of the value comes, especially if you're looking at multifamily, is the value comes in increasing NOI and then attaching the same or slightly compressed multiple that you believe you could sell the asset for 2, 3, 5, 7, 10 years down the road. So you can see that this NOI is not a significant difference. It's about 22 grand. But I mean, in terms of the valuation, if we apply a 9% cap rate to that, well, that could be almost, 2.5, 300 grand in value capture upon an exit. And so just by lifting the rents about 20 grand a year, we're able to, increase $250,000 to $300,000 in potential value. So now what we want to look at is sources and uses. So if we were to finance this, how would it be financed, and where is the capital going that we're raising? So the purchase price, this is a plug. So I'll talk to that in a second. But again, remember, it's listed for $1.12 million. So we have to assume closing costs, due diligence costs for a total acquisition investment or an upfront investment. And then we also have to assume the CapEx. So there's going to be work that needs to be done for the property. So you can see I split it out with owned homes, current pads, and new pads. So owned homes are the property owners. So if we were to buy this, we're also going to get, remember, the 10 mobile homes that are owned here. So park owned. So there's 10 homes that are owned. Well, we don't know what the shape or the condition of those homes are. And so we're going to have to make an assumption as to how much money are we going to need to put into those currently owned homes in order to get them up to what would be considered market rate rent properties. Then we also need to look at the current pads. So if you know mobile home parks, and am I a mobile home park expert? No, but in terms of underwriting and looking at a deal and the financials behind it, the number crunching is very, very similar across asset classes. What's different is the execution and how you need to repair the asset in order to realize the value. And that's where the domain expertise comes in. So in terms of the pads, we would need to have an expert go out there and look at the pads and say, what condition are these in and how much money would it take to invest into these pads to get them up to where they need to be for market rate rent for the pad. So we have to make an assumption for the pad investment per unit. And then we also have to look at the new pads. So there were 7 pads that they mentioned that were not used. And so I kind of filled those in with question marks here, where they didn't have a tenant and they didn't say empty, rent, or sell. So I'm going to assume that these pads are not finished. I'm assuming they're just raw land that we're going to have to develop. And so we're putting in an assumption there. So I said 10,000 per unit. That might be low, that might be high. Again, these are high-level assumptions to check whether or not the deal is feasible. So then we have our total capital expenditures for the deal. In terms of acquisition plus the total CapEx, that's our total uses for the proceeds. And then for the financing, we can make an assumption for 70% LTC, rate 8%, term 10 years, amortization over 30 years, interest only period 12 months. Now, again, this is back of envelope estimates. So do I know that a lender is willing to meet these terms on the deal? I'm not sure. But this is something that we could put these in, see how it pencils, and whether or not it's even worth our time talking to a lender about. So now we can see our loan proceeds, the 70% loan to cost is going to be 570, call it 580 grand. And then we're looking at an equity contribution to meet the difference of about $826,000. So if we look at our current and our potential NOIs, and then we take out the debt service payments, then you can see our current is about 15,000 cash to equity before taxes and CapEx. And then we have our potential NOI at about 33 grand. And so our debt service coverage ratio, it's greater than 1.25%, assuming those loan terms. So that would most likely pass the DSCR test for lenders. So now let's look at the cap rate. So we're buying in, let's assume at 9.25% or a 9.25 cap rate. Now we could assume that we sell it at the exact same or slightly compressed. This is 25 basis points compressed. I think that if we were to put in this money, this capital, fix up the assets, make the pads and the homes significantly better, get it filled to market rate rent, I think it's reasonable that an investor, assuming it's turnkey with professional property management in place, I think it's reasonable that an institutional or an informed investor would consider purchasing the asset for a 9% cap rate. That would be interesting. So if we look at that, then we want to look at our yield on cost. So after we put the money in and let's say we go through the deal, we get it to the potential. So that gets us to a 10.1% yield on cost. Well, I like that because the yield on cost is higher than the cap rate. So what that tells me is for the money that we put in and the cash stream or the income stream that we're generating on that asset, we are returning a 10.1% on the cash that we put in. And we believe that an investor might be willing to buy it for a 9 cap. So we have about a 1-point spread there in value creation. So because of that, that tells me that this is a value creation opportunity. So in terms of cash on cash, you can see the unlevered, you're able to see the current versus the potential. In terms of positive leverage, is our IRR and is the yield on cost greater than the cap rate and the cost of capital that we're implementing in order to actually do the deal? Yes and yes. So that's good. That means that if we add debt and lever this investment, it's going to be a positive net effect on our equity returns. So if we look at a 3-year hold period for unlevered and levered, you can see about 11% unlevered and a 17% for levered. Now, again, there's a lot of assumptions baked into this. There's the P&L and the actual NOI. There's the exit cap. And then there's also the amount of money that we're putting in and how much we're able to finance. So these IRRs, I would not look at them and say, yes, these are totally serious. Instead, I would look at them as they're indicative that if I'm serious about looking at this deal further and potentially doing some inspections, potentially talking to some vendors to confirm more of these numbers, that if we believe that this is close, and if we talk to the seller and we believe the seller is reasonably considering selling at a lower price point, because I do not think that this is worth 1.12, and I don't think it's even remotely close to what they're asking. Do we believe that we would get the seller to believe and agree with us that the valuation needs to be lower? So it never hurts to make an offer. So if we're able to put rough numbers, talk to some vendors, do a little due diligence before I make an offer, get this to a tighter price number or to a purchase price that we're confident in, and then make that offer. If we believe that's worth it, and then we go through the due diligence process, this could be a potentially interesting deal. So I'm sharing this with you, and then you can see kind of how the cash flows pencil. You have unlevered cash flows here. So you have your due diligence and acquisitions costs up front, your closing costs, your capital investment into the project itself. And then you have your year 1 NOI, your year 2 NOI, year 3 NOI, and then the exit. And then that's our terminal. We're discounting that back, IRR formula, and then that's how we're getting the unlevered and the levered IRRs. So in summary, if someone believes that they have the skill or the relationships in order to execute on a mobile home park and take this business plan and make it successful, then yes, I think that this is a pretty attractive or an interesting deal to do further. If they're able to hit higher than a 13% levered IRR net to investors, then I think that there's a good shot that investors would consider this relative to other current investments in the marketplace. Now, granted, they're going to want to understand who's the operator, who's putting this in place, what amount of capital is expected of them, and then do they have a preferred return, et cetera, et cetera. But in summary, sharing this with you, I think it's interesting. I do think that there is money in mobile home parks if you know how to do the business plan of the fix and flip of the mobile home park. So with that, my name is Jamie Carlstedt. I'm the founding principal of Dojo Real Estate. I'm based out of here in North Carolina. I work remotely with a lot of people on their different deals. And I do outsourced underwriting, and I'm also a deal partner with different investors. So if you're looking at a project like this and you need professional underwriting or someone on the deal team to be able to be the numbers person, please reach out. I'd love to chat about it with you. Or if you're looking at individual homes and you need outsourced underwriting, or you just need to talk to somebody about the deal economics to make sure that your numbers are tight, the benefit there is you're able to raise capital a lot more easily with both equity and debt investors. But then 2 is you're going to make sure going in, you're buying right, your deals are profitable, and you're not overly at 80, 90, 95% loan to cost on the loans up front. They're doing 6, 12, 18-month bridge loans. They're going in, and what they're doing is they're exposing themselves to a ton of risk on the back end without knowing the deal economics and whether or not they can make their debt payments. So if you want to know your numbers better, please reach out. Jamie Carlstedt, Dojo Real Estate. My number is 248-339-6484, or you can email me at jamie@dojorealestate.com. Have an awesome day.